All right. Well, good afternoon, everybody, and welcome to a special Saturday afternoon session in the sun here in Michigan. We had filed a missing persons report on that orb in the sky, and it's back today, and that's a wonderful thing. Um, we have entitled this session before, during, and after a storm, at least for the subtitle, and we certainly like to see that sun in the sky. Wouldn't you agree, Mr. Kavula?
Absolutely. I'm going to go out and sit on the deck today. It's a resolution that I'm going to keep.
All right, well, welcome everybody to this session. It is about portfolio design and management. We want to talk about selling guidelines and give you a little bit of an update on some of the stuff we've been looking at. It's really starting to solidify, is the bottom line. And we've really got some interesting findings and evidence to share with you. Hopefully, Cy will be able to join us, but we'll muddle our way through as best we can here for the next hour or so. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, one of the co-sponsors of this session. I am joined here by Ken Kavula of the National Association of Investors Better Investing Mid-Michigan chapter, the other co-sponsor. Good afternoon, Ken.
Good afternoon, Mark.
You're not on the deck yet, right?
No, I'm not on the deck yet. I'm sitting at the kitchen table in my bay window looking down in the forest right now.
Are you wearing pants?
I'm wearing pants.
That was a question from the pre-session for those of you wondering. All right, just a quick reminder, no investment recommendation is intended. This is all about education. It's for demonstration, illustration, and all that kind of stuff. It literally is do your own homework time, people. And we will disclose when we have a personal situation at stake, but it really is about attempting to capture the wisdom and lessons learned over the last 80 years by the modern investment club movement. If you would like to be added to the event email reminder list for this type of event, we run a couple of them basically every month, including our monthly roundtables. nkavula1@comcast.net is Natalie's email. Please drop her a note if you'd like to be included. If you'd like a copy of the slides or if you have follow-up questions, my email address is markr@manifestinvesting.com. And oh my gosh, the number of you guys out there that sent and requested copies of slides from yesterday, it's just an honor and privilege to get to communicate and correspond with you. All right, we're down to session 4 of the conference. This one is intended to be selling guidelines. And I'm so sorry that Cy's not here, that I converted the two guys to the three amigos there on the left. I'm sure he will be happy to see that when he is able to join us. But let's just go ahead and get underway. I'd like to just kind of kick things off with a reminder that we're going to talk about some stuff here today that we think is a little different spin, but not terribly different than what we've talked about for years when it comes to selling. We're going to honor tradition. We're just basically trying to seek enhancements and maybe a little bit of definition. For years, we've been working with individual investors and investment clubs. Selling a stock is not easy. It is not un-American to sell a stock. Don't be stubborn about it, and don't let the taxes get in the way either. I've got war stories I could tell. I'm not going to do that right now, but I have seen the consideration of taxes actually get into the way enough that it completely wrecked a very profitable scenario for one of the investment clubs I was affiliated with. Take advantage of selling opportunities. All of us here believe that there are buying opportunities. If you believe there are buying opportunities, you have to believe there are selling opportunities. Period. More Socrates this afternoon, Ken. All right, here's the 3 reasons we think that it's okay to consider selling. Many of you have seen these slides before. This is the one slide I use ever since that September 2004 column in Better Investing where we talked about selling. First, you need the money. You need to cash out for some reason. Some of the reasons are listed there. I have experienced the joy of a daughter's wedding. Other things have come around that needed money for. Could be to take the club portfolio and pay somebody that's doing a withdrawal from the club. So that can be the number one reason. That's a perfectly legitimate reason to have to decide on selling something. The second, we're going to spend a fair amount of time on this here today because the fundamentals or quality are in decline. What do you watch for? How do you gauge that situation? How do you intervene when required? We will be talking about that. And again, as all of us know, if it's on CNBC and they're interviewing the FBI and the SEC in the parking lot, it's too late for your stock. And number three, and we really hope Cy can join us because he loves to talk about this one, because the actions you take can make the portfolio better. It's that simple. We have some fairly simple objectives for the design of a portfolio, and it really is a matter of just keeping them in line and on target, enough growth, enough quality, and be prudent about the diversification. So those are basically the three reasons, and some of the stuff that we're going to be talking about here today, and this is my personal opinion. I'm going to turn it over to Ken and let you see how much he agrees with me. We just think we're embedding the stuff we're talking about here today in that. So go ahead, Ken. What are your thoughts on this?
Well, we don't want to give the impression that anything that we're doing is out of the ordinary. Better Investing has given us a firm foundation for selling, and the kind of ideas that Mark was just talking about are absolutely bedrock ideas. They make it easy to sell when one of those items has been hit. If you need the money, then sell a stock. If you have to look at the fundamentals, and if the wheels are falling off the company, then sell the stock. I think one of the most difficult things for us to do when we're deciding when to sell is looking at a company where the potential has reduced itself. One of our darlings, for example, one of our favorites, maybe something we've held for 5 or 6 years, and the potential has moved from a good solid 10, 12, 14% annualized down to maybe 2 or 3% annualized. Well, you have to trust yourself. You have to trust your analysis, trust your stock selection guide. And when those potentials move down to a place where they're no longer competitive and where they're no longer contributing to the growth of the entire portfolio in the manner that you expect them to contribute, that's a great time to sell. All of that being said, I think we also want to sell with an eye not only towards preserving capital that we've invested in a particular stock, but I think we also want to consider preserving capital gains. A lot of times I've watched clubs take great stocks, follow them all the way up, triple, quadruple, quintuple, and then be afraid to sell the stock and have it come all the way back down to nothing. I won't ask you to identify yourself, but I'll bet there's people out there in the dot-com bubble that held on to Cisco Systems as it moved way, way up, and then as it crashed and lost most of its value during the burst bubble right after the year 2000. So let's explore some of these ideas about capital preservation and rate of return potential, and let's see if some of these other ideas might give us a little bit of an edge on top of the tried and true.
Okay. All right. I'm asked this question quite often, and my answer has never changed. I think the most important tool for portfolio management is the stock selection guide. A completed current stock selection guide with well-considered expectations and judgments about what the outlook for the company looks like. We're looking for up, straight, and parallel for our core portfolio, and we do think it's prudent to monitor, what does your stock look like over time? That inset on the right-hand side of the chart here, we refer to them at Manifest Investing as chronicles. It's a chronicle of what's been going on with, in this case, it was Costco for a 4-year period. The green bars are the price. The blue line up at the top is the quality. We think of it as a quality EKG. Excellent quality, clicking along up at the top. And then most importantly, again, if stock prices fluctuate and expectations fluctuate, then return forecasts have to fluctuate. And so what you're looking at here would be basically a monthly snapshot of a stock selection guide according to the analysts that follow the company, analyst consensus driven. Think of it as a stock selection guide. The return forecast on a monthly basis, the projected annual return, it's a snapshot. So you can see one of the better buying opportunities is over here. And for the right club or individual under the right situation, this was a potential selling consideration. All right. So you want, again, buying up at the high end and selling at the low when it comes to the Chronicle. So again, the cog in this entire machine is the results of a stock selection guide based study. Ken, did you have any reinforcement you wanted on that, or is that good to go for now?
I think you've said it in a nutshell, Mark. The SSG is central to everything I do, and the Chronicle, which is just 45 or 50 SSGs on the same stock, just collected over time and displayed on a graph. That is a tool that I use quite often as well to determine if I'm buying a stock when its potential is near a historic or at least a 4-year high. And I'm also looking all the time at the quality of the stock. I don't want to get myself in the middle of a stock where quality is in decline.
Okay, so obviously watching those two components are going to be part of the story here today. So I'm going to spend just a couple of minutes on the you need the money part. And basically what it comes down to is take whatever portfolio where your resources are stored, cash brokerage account or whatever. And what you want to do is, again, focus in on, well, what are the expectations? And we're going to literally take a look at, what are the companies? These are all pretty good companies with a couple of speculative exceptions. Pretty good companies. We want to know which one has the weakest return expectation. Now, you can have an excellent, great company that, because the price has been soaring, has a low return expectation. Apple comes to mind. It's the second one down there. The Apple has just been going nuts when it comes to the price. It's actually beginning to dominate a lot of our portfolios again. So you would audit and you want to take a close look at that projected annual return. So that's the sort of thing that you want to do. So let's pretend that Mark needs money for something and that Mark has access to this particular portfolio. And what Mark needs, in Mark's opinion, is this car. Ken, do you recognize that vehicle?
Well, you told me when I asked you what it was that it was a Bentley. Are you lying to me, or is that true?
No, that's true. I mean, that's the Bentley. That's the Bentley that if my wife were to buy this for us, we would take this Bentley to Punxsutawney.
Okay.
Now,
I would get to ride in the front seat, in the shotgun seat. All right.
Yeah, we could trade off. You can drive too. I mean,
in that case, buy it, Mark. Okay.
This could be a really now. If you want to step up and buy it, that's a whole different equation because I actually asked Alexa, what does this car cost? And the answer was $206,000. And I went back and checked my nest egg here, cash on the side. It barely has enough to cover that, so I had to rethink my situation. My wife stepped in and did the rethinking for me. And she said, I work for Fiat Chrysler. This is what you're going to get instead. And thankfully, that's about 1/7 the cost. So now I'm working with that portfolio, and I want to go in and figure out how to make the money, how to withdraw the funds that I need. What I thought we would demonstrate, I'm going to be really risky here. I'm going to jump out of the presentation. We'll go live to the Manifest Investing website. We'll go to my brokerage account. And what I want to demonstrate is how easy it is to do this. We're going to go to the worksheet on this particular fund. Let me shrink this down just a bit so we can see it on the screen. Okay. And now that I'm in the worksheet, I'm going to sort it by the projected annual return. Now it's sorted from highest to lowest. I'm going to go back and sort it from lowest to highest so I can bring the ones up at the top into full display. So again, these are great companies. They've been really good to me. NVIDIA, I think I only paid $1,000 for it. It's gone up $4,000. That's nice. And the projected return now has actually dropped down to, it's amongst the lowest, again, in comparison or relative to the other stocks in this portfolio. So I'm going to say, okay, NVIDIA, that can be part of my new Bentley. I'm going to name the van Bentley, by the way, Ken. That's the name of the van. So we put that down there. The money goes down into the portfolio down here. It's on standby, and we've got $5,000 in cash. Do the same thing for Apple. Love Apple, love the company. It's been really good to us, but I need to buy that van. So we basically send Apple into the holding zone. I still don't have quite enough to pay for that van, so we'll go get the next one. That's Novo, another company I've really enjoyed owning for a while, but we'll drop that down and actually generate the cash by selling these three positions. I now have enough money for my van. So all I've done here is demonstrate that take the portfolio, take the dashboard, and really begin thinking about selling the companies with the lowest potential, the lowest promise of reward. And that's saying nothing about what they've done for us, so far. It's just looking forward and basically just using the portfolio to drive that type of a decision. Now, there may be situations where you reach down the list and perhaps sell a lower financial strength stock or that sort of thing, but basically selling the ones with the lowest return potential is going to be a pretty good idea a great portion of the time. So that's my dissertation on, I'm going to sit here and dream that Ken and I are running around in that Bentley while we're in that. All right.
Well, let's take a closer look at that quality idea, Mark. First of all, I want to remind everybody that the quality that you see on the Manifest Investing site is measured in percentiles. The quality ranking is an aggregate of 4 basic ideas. Relative profitability. What that means is the profitability compared to a peer group or an industry group. Higher than average gets you more than average points in that category. Lower than average, the same general idea. Sales growth, and again, it's relative sales growth as compared to a peer group or an industry group. The other 2 categories are financial strength, the strength of the balance sheet, and earnings predictability. How straight is that line? How predictable is that line for earnings on a stock selection guide? If you use those as the 4 pillars of quality, then we've noticed that when quality declines by 10 or 15 percentiles, many times that gives us a 3 to 6 month lead on the stock itself actually beginning a decline. In other words, a declining quality seems to precede a decline in stock price. If you could go to the next slide, Mark, we can look at those different ideas again, just for emphasis. Remember, quality, 4 basic ideas. Relative growth in sales, relative profitability, depending on what a peer group's profitability looks like, financial strength, and earnings stability. One more slide, if you would, Mark. And we look at a sheet that's tied to one of the companies in the database. There's the raw numbers for quality at the bottom of the sheet, and notice they tally to 78.3. We'll call those quality points or raw quality points. Once you have a raw score for every single stock in the database, then you can turn them into a percentile score, and that raw score of 78 turns into a fairly high percentile of 96. That means that this raw score is better than 96% of all the other raw scores in the database. There's only 4% of the scores better than 78.3. That's a really high quality. When we look at the best stocks in the database, as far as quality is concerned, we tend to look at quality at 80 or above That's the top quintile, the top 1/5. One more slide, if you would, Mark. Here's that chronicle for the same stock. This is Neogen, and Neogen's been a home run stock for me and my wife for, oh goodness, over 20 years now. It's the kind of stock that if you can duplicate the home run characteristics 4 or 5 times in your lifetime, then your nest egg is pretty well set. Notice the relatively consistent line for quality. There's been some burps in it, there's been some up and downs, but notice that it's managed to stay well above the 80 mark for at least the last 4 years. And notice the times, actually fairly recently, when Neogen could have been purchased for one of the best par values that it's had in the last 4 years. That looks to me to be around November or December in 2018, where you could have put some money into Neogen, and perhaps it was a great time. More recently, the par value has come down to something much more on the average, but that average represents about 9%. I will take any medium-sized company that over long periods of time returns me 9 or 10%. The medium-sized companies are the workhorses of my portfolio, and if they're going to return to me 9 or 10% or better over time, then I will keep them in my portfolio.
Yeah,
Mark, anything to add?
Yeah, again, in the spirit of it being a selling discussion, we are a community of optimists. We're always looking for these peaks, and that we are wired to look for the peaks on these return forecast charts. I want to draw everybody's attention to this one, the trough. Basically down in here, that is a potential selling opportunity. And again, what I want to draw your attention to is it came at this peak price. So again, if you're looking at a portfolio, if you owned shares of Neogen and you needed to buy a Bentley, this was a time to think about Neogen as a possible source of funds, depending on how it stacked up against the rest of your portfolio, of course. Go ahead, Ken.
Absolutely. This idea of watching quality over time and considering a sale when there's a sudden drop, this is a hypothesis. This is an idea. And Mark and I have been testing this idea now for the last 3 or 4 years. We think we're beginning to get enough data for us to say this is a pretty good idea. When quality drops consistently, you give yourself a little bit of a lead time before price drops. Now, it's not lockstep, and it doesn't happen 100% of the time. But we find it happening more than 3/4 of the time, and to us, that's something that's worth watching. Here's some examples of what we mean, and while the examples are still anecdotal, they illustrate exactly the point that we've been trying to make. This is the Fossil Company. They make watches and they license or they sell their watches to other people who put their own brand on top of them. So many of the fashion watches that are in the world today are actually being made by Fossil. Well, look at the large quality drop it had in 2015, right about the time that the Apple Watch came out. That quality drop was followed for quite a while by a stock price that didn't follow it down into a bad place. The stock price remained in the $45, $50 range for quite a while after the quality drop. It wasn't until about 3 or 4 months later that you saw this large drop off into the $20 range. And then the bottom fell out of the Fossil market around April 2017, and the stock went from around $10. It stayed there for a while, and then it really dropped down to $4, $5, $6. Now, it did do some recovering, And this chart is showing that it did recover to that $10, $15 range. But if you were wise and sold on the first dip, the first downward dip in quality, the first really substantial dip in quality, you preserved quite a bit of your capital. You might have preserved as much as $30 or $40 per share of your capital. And that's something that is worth thinking about as you move forward. So we're watching quality pretty closely. Go on, Mark.
This is also one of those answers to the question. You know how you meet in June and you buy the stock at 40, you come back in July and it's at 30, and somebody actually says the words, "We liked it at 40, we must really love it at 30." And I look at this picture, and this is exactly the way I think about it now. The way I think about that 30, if that blue line is headed down on the quality trend, my answer is no. One of the things I've learned over a career of investing is don't fight that quality trend. I mean, it's just a really nasty thing. I'd really want to see that quality, because keep in mind, it's unemotional and it's mechanical. It means something's wrong. The growth rate is slowing, or it's losing ground versus competitors, or their balance sheet is weakening. So all of that stuff matters. Go ahead, Ken.
Here's Mesa Labs, and without belaboring the point, the same thing is true there. You see that gigantic quality drop back in the beginning of 2017, and yet the price held at about the $140, $150 mark. It wasn't until 3 or 4 or 5 or 6 months later that the price moved back down into the 125, 135 mark. And again, you could have saved yourself $10 to $15 to $20 in capital if you would have sold after that quality dove and after it moved to a place where it was no longer in the top quintile. We're going to monitor our holdings in all of our portfolios, real money portfolios, and some of our imaginary tracking portfolios, watching for sudden drops in quality. But we feel that the data is really piling up right now to the point where when the quality drops 10 to 15 quintile points, that's a really good indicator that we might want to get out of that stock. It doesn't necessarily mean something's wrong with the stock, but it does indicate to us that the stock might need a timeout.
All right, let's switch gears and talk a little bit about kind of a new subject that we've been kicking around for a couple of years, and we have kicked this around a lot. I entitled this because things are just not working out. This is actually modeled after a line of thinking that is used by momentum investors. Many of you out there are familiar with IBD and Bill O'Neill. He talks about they do an awful lot of momentum chasing. I'm not criticizing it. It's a different way of investing. But they're investing in companies where if they back up and drop 8%, they use that as a stop loss. And they basically, no questions asked, get out. But we're investors, not traders. So we basically want to counsel, take the position that you're looking at. If the market drops 10% and your stock drops 8%, you're actually beating the market with a long-term perspective. So again, this concept of relative or compared to the market, and if your stock does drop 8%, kind of back to that, we liked it at 40 a month ago. What do we think about it at 30? You want to get in there and check out the long-term prospects and whether or not the return forecast is still strong. So this is a capital preservation concept. Capital preservation. Every once in a while, no matter how thorough the studies are that you perform, bad things happen. Keep it simple. We basically have settled on tracking the actual relative return and comparing the return on your stock versus the Wilshire 5000 or S&P 500. Anytime a stock drops more than 20% compared to the market, we're basically going to do the same thing we do with our grandchildren. It's time for a timeout. And that's what we have been looking at for some period of time. We believe that this is basically a subset of rule number 2. The wheels are coming off. And what we expect to find. In fact, we think this is so true. You do 5 studies, develop 5 expectations for companies. This is a rule of 5 that better investing people have been chanting for decades. This is the type of outcomes we expect. We expect 1 to surprise us to the good side, 3 to do pretty much what we expect, and 1 for reasons sometimes that defy understanding or description. Will it be disappointing? And we want to try to pick out that 1. Interestingly enough, we have now been doing the roundtable for 10 years. We've made 550 purchase decisions. 76 of them actually met that criteria that I mentioned on the previous slide. That's actually only 14%, so we're actually doing pretty good, I think, in terms of overall. More to follow on that. But here's really our poster child. Back in April 2015, I gave, many people have told me this, it's not just me, that I gave one of the best. Did that sound presidential? Let me back up. I didn't want to say, all kinds of people told me, and this is huge. No. All right, Mark, get a grip. Knocking on wood again. All right, I actually did a pretty good study. This was a good situation on Iconics brand. Ticker ICON. The company is still alive today. But during that presentation, you can go back and listen. I said, I really love this situation. I think there's a lot of potential here, but if this thing drops down to 800 versus a flat market, we're getting out. And we did. We exited the position in the roundtable. That was kind of the inspiration for this type of thinking. So $1,000 invested, that's what we do at the roundtable. We put 1,000 hypothetical dollars into them when we make the decision and select the company during the roundtable. 4 months later, it was worth $800. Well, lo and behold, a few months later, actually it appeared over the next, this is the answer to the question, how many times can you lose 80% on a single stock? Because I think it would have been like 5 different times on this stock. And by August of 2018, the stock was worth $20 to us. So our $1,000 would have become $20. So we think we protected the 800. Now, there is good news here. Over the last several months, since I made this slide, the stock's up 34%, so we've gained $6. You're all allowed to chuckle a little bit out there. I think I hear internet-based cyber chuckling going on. Yeah, up 34%, not exactly anything to go crazy about. But anyhow, here's a case where we protected ourselves from a loss of capital, once the wheel started falling off for whatever reason. Now, I personally believe that my plan that I presented during the stock study was foolproof, and that management of the company simply failed to follow my directions. That's what happened, and the companies often don't listen to me. So, actually, no signs of a sigh yet. So I guess we'll tackle the next slide ourselves, Ken. I've got us at about 35 minutes, so we should be able to spend a decent amount of time talking about the third reason for selling a stock, and that was what George Nicholson believed was covered by as much as 90% of the situations involved in managing a portfolio. Why don't you go ahead, Ken?
Okay, well, we're looking at a portfolio from 2018 so that we don't have anybody out there trying to copy the portfolio. The stocks are pretty decent stocks. This is the Mid-Michigan Model Investment Club back almost 2 years ago. And I'm going to start in the upper corner because this is a fairly simple chart once you understand a few of the key concepts. In the upper corner, you'll see something labeled MIPAR. That's MIPAR. And what that stands for is the Manifest Investing Potential Annualized Return. Think of that as the average return after you've done a stock selection guide for the par value. Now, par is the potential annualized return using the average PE. On a stock selection guide, it's one of the choices that you have in section 5. That's the last section. And it's been there for years and years and years. And it's the measure that we use. Over time, over many, many decades of history, the par value for the entire market really rests around 10%. So in 2018, when we were looking at this particular portfolio, we were looking at a portfolio that was a little bit overvalued. And when you're overvalued, you drive the potential for the future down. Make sure that that makes sense to you as I'm explaining. The average for the market is 10. The average on this day was 7.3. The par is less than average, which means the stocks were overvalued at this particular time.
Excuse me, you're talking about the market in general, right?
The market in general, right. Now, look at the box beneath that my par box. You'll see it's called the sweet spot. George Nicholson advised us right from the beginning of Better Investing to look to put together a portfolio that returned about 15%. He was talking about the entire portfolio, not each individual stock within the portfolio, but the entire portfolio. Well, if he's talking 15, and if the market average is 10, another way to say what Mr. Nicholson was recommending was beat the market by 5 points. With the advent of computers, we're certain that that's where our goal would have evolved to if Mr. Nicholson were still alive today. The goal, beat the market by at least 5 points. When the market average is 7.3, then aim for stocks that are going to return at least 12.3. That's 5 points above the average. Mr. Nicholson also indicated that beating the market by more than 10 points was nearly impossible to do, and you shouldn't be attempting to do it, at least not on a regular basis. So we cap the sweet spot at 10 points above average. So that 12.3 to 17.3 becomes the goal where we'd like to buy our stocks, and it becomes the goal where we'd like to keep the total par for the entire portfolio. Well, look down now to the next window that's labeled Portfolio Averages, and you'll see that the aggregate par for this entire portfolio, and it's a weighted average. That means the larger holdings contribute more to the number than the smaller holdings. The par is in the sweet spot, and that's an A. So give it an A. We like to keep the quality at 80 or above. That's the aggregate quality as a weighted average. And again, it's above 80 at 92.7, another A. Mr. Nicholson, from our class last night, you might remember that Mr. Nicholson said if you can keep growth between 11 and 12%, and that's sales growth, then you have a good shot at meeting your target goals of beating the market by 5 points. Well, 11.9 is certainly between 11 and 12%. Another A. We go down to financial strength, where we set a target value of 80 or better. These are averages, and that financial strength number of 83, another A. And we also set the target for stability, EPS stability, at 80. We're at 79, so we'll give ourselves an A with a little minus sign after it. This is one really, really nice portfolio at this particular time. Let's look at the chart itself, okay? Notice that some of the stocks on the list don't have any value to them because we don't own any shares. Folks, that's our pounce list. As of 2018, those were the stocks on our pounce list. Did we ever buy any of these stocks in the last 2 years? Yes. But we bought them when they had par values that contributed to keeping the total value of the portfolio par at a place that matched that sweet spot. Notice the averages at the very bottom of all the columns match exactly the averages over in the little box on the right. And notice that if I want to get rid of some stocks that happens to be, if I need to raise cash, notice that the portfolio is sorted in terms of par. Folks, have you been at an investment club meeting where you've had to sell a stock to raise money, perhaps to pay out a departing member or something similar? I know how long those types of meetings can be. I will tell you that when we're in that position in our model club, we're looking at our dashboard and we're saying we have one, maybe two stocks that we should consider selling in order to raise cash. We look to the bottom of the list, and it happens to be FactSet and First Financial Bank shares, and dispassionately, without any emotion, we're ready to raise that cash by selling off the lower par stocks. That doesn't mean that we can't keep them on the pounce list. That doesn't mean that if their par value goes up in the next 8 months, that we can't buy them back. But what it does mean is right now, they will actually contribute to making the portfolio better if we were to sell them. If we wanted to buy something with a higher par and sell something with a lower par, I will tell you that will raise your averages. And that's the goal always when you're dealing with selling to make things better. You want to make the overall return on the portfolio better. And if you don't know what the return is, you need to calculate it so that you can work with the numbers and move towards a place where you're going to actually be beating the market by those 5 points. That was the original goal back in the 40s when Better Investing was founded.
All right. Well, Ken,
Mark,
it looks like
I think I've covered it.
Yeah, with the cash and with the proceeds of sale from the two companies that you're selling, you got about half of what you need for the Bentley. So I suspect that this club, I know this club well, would have been looking to shop at the top of that list. What's the club's perspective on that yellow, too good to be true for Ulta Beauty back in that time frame?
I'll tell you that when we got into examining this company and the growth characteristics and the number of stores that it was opening and the fact that it only represented 2.7% of our portfolio, in this particular time frame, we actually did sell off the bottom and put some of that money into Ulta. A normal holding for this number of stocks, and I think we own about 14 or 15 right now. A normal holding for this number of stocks is about 7%. So we could easily add 4 or 5% to that Ulta Beauty holding and still stay within a normal range. That 20.8 is not far enough above the top of the sweet spot to cause a lot of issues when you actually explore the growth characteristics of the company. The same thing was true at this time for NetEase, that when you actually explored the growth characteristics for the company, you could believe that it was possible for the company to hit those particular numbers. And our SSGs, Mark, bore out these particular
Mm-hmm.
high numbers. Even doing conservative SSGs, we were coming up with par values of 18, 19, 20, 21%.
Mm-hmm.
So, if those numbers would have been in the 30s or the 35 range, probably that would have been too good to be true. But we thought they were fairly believable at this time.
Yep. So what we're basically showing is this is portfolio-centered decision making, and the portfolio is driving. Now, if there wasn't an opportunity to accumulate up at the top, I know that Ken's club would have gone shopping outside the portfolio, and that's the subject next hour. But very good, good stuff. All right, let's go ahead and keep crunching. We just thought we would spend a moment just reminding that it is okay to buy some frisky stocks. We want up straight and parallel. We want, something like 75% of your portfolio to be that. But it is okay for an experienced investor to buy in some of those other non-core type situations. Nicholson referred to them as general market securities, but it could be a turnaround. It could be a low growth company. It could be, could be the current Budweiser, which is somewhere between core and non-core in most people's minds. Could be a Hugh McManus biotech. But you can actually go in there and dabble a little bit. A number of us have invested in Ardelyx, ticker symbol ARDX, as a non-core speculation. So it is okay to do this. And again,
Mark, I want to interrupt and let you know that the third of the three amigos has arrived.
Oh man, you missed your opportunity. We'll go back and show you in a few minutes here, Si.
All right. Yeah. Sorry, I had the time wrong in my head, though. I had it in the calendar, but
Yeah. We're sorry too. Sorry. We'll keep going. But here's just a quick reminder of, and this is actually a demonstration. Ken and I were involved with a club that was actually threatening to disband several years ago, and the problem was they had a civil war going on in the club. Some of the members wanted to buy some of the more speculative type stuff. Others wanted to stick with Johnson & Johnson, Aflac, and Abbott Labs. We get that. And we actually showed them this slide from Nicholson right out of the book and basically gave them permission from on high to do what they wanted to do. And what was so cool is I went back to a couple of their meetings in the future. They actually put yellow crime scene tape down the middle of the living room, and they sit on opposite sides during the club meeting. So they have a core side and a non-core side. It is okay to do this. I do this with my own portfolio in a big way. It is okay to invest in that kind of stuff. We do encourage that you have a different perspective based on which side of the yellow tape you're on. Why don't you go ahead and describe the Si, are you warmed up enough? Do you want to take this on? Or did he sneak away? He probably muted himself already.
He might be muted, yeah.
Well, go ahead, Ken. Describe.
Okay.
Here he is.
Yeah, I was talking into a muted microphone. All right. So the selling discipline based on individual stock par values, Ken, I think, was talking as I came in about portfolio-centered and looking at the par. If you have a core stock that drops below a money market return, then you certainly would do better off long term, in our view, by going into the money market. Right now, that's very low. In fact, immediately 1.5 to 2%, almost a little high.
It is.
So you under current market conditions, you would almost never sell a core holding based solely on the stock's potential return. Now, non-core holdings, you're taking more of a risk. And by risk, those of you who have heard me talk about risk, I'm not talking about volatility, although non-core holdings are likely to be more volatile than core holdings, but just risk of potentially losing your capital because the company goes down and stays down, or eventually goes out of business or something. that's when we want to compare the potential stock return to the market return. And that, again, is generally measured by MyPar using the manifest tools. That's what an average stock would return. The basic theory there being, if we can buy average and get a particular return, we want at least that much, if not more, out of our non-core holdings.
Thanks, Si. All right. I'm going to skip over these for right now because we are coming up on the hour point. We might come back to those if we have Q&A. So let's talk about results. As most of you know, the Roundtable's been around since July 2010. We are coming up on our 10th birthday here in a couple of months. It's been a heck of a good time. You can see that the results for the Roundtable have been about approximately 16% per year. That's a rate of return annualized versus about 8. Let's call it 8% for the Wilshire 5000 using matching investments over the same time. So in the Roundtable, we have been, now you guys correct me if I'm wrong on this, but we have not been 100% disciplined with respect to some of the selling stuff we're talking about here. Some of us get a little emotional and attached to our stocks. Is that a fair statement?
Yeah, you're probably talking to the two wrongest people to talk to about that.
Anyhow, we've attempted to stay disciplined, but it's been a mixed bag. But we basically have been attempting, we've been doing much better over the last couple of years of applying some of the stuff we've talked about. And we can get into more of this with the Q&A. But I'm sitting here and I'm wondering, you know, how we've had a lot of sell transactions. If you look at the tracking portfolio, I asked myself a very simple question. What if we didn't do that? What if we simply bought, you know, did the traditional buy and forget? And the only way a stock will come out of a portfolio, a tracking portfolio, under those conditions is through a merger and acquisition or a gulp bankruptcy. Okay, so is everybody with me? I'm saying I want to compare our managed portfolio using the selling disciplines we've been talking about here, which we hold up our right hand and say we have not been perfect on. We're humans. We're trying to get better. Versus what if we just done nothing and let them fly? And I'd like you to notice the result. Our 16% return in a buy and forget implementation would have dropped down to between 11 and 12%. That golden part that you see there would have disappeared. So that what that is telling us is this is pretty good evidence. We're talking about 1,000 transactions over a 10-year period now. Okay, buys and sells. And implementing these strategies have added anywhere from 4 to 5 percentage points to the results of the Roundtable tracking portfolio. And we think that's pretty compelling, unless I'm missing something. I do this every day. I think that's a pretty interesting piece of evidence. Any thoughts on it, guys?
My only question, and I'm just trying to think back to some of the cells if they were clean or not, is which since we're not as focused, I would say the criteria that we've probably applied the least in the Roundtable portfolio is portfolio return as a selling criteria, the need to sell to raise portfolio par. I think y'all would agree with me on that.
Yeah, and in fact,
so how much of those were quality sells where we said there's a quality problem versus value? I'm just wondering about that.
Yeah. The answer is somewhere between, let's say, approximately 80 versus I want to say maybe 140 sell transactions that were driven by just taking care of the portfolio.
Yeah.
So 80 timeouts.
And Si, I agree with you that I really think that if we were going to focus on the core ideas about portfolio management, portfolio-centered management, I really think that we might be able to push this percentage even a couple points higher than it presently sits. I do think we've gone through relatively long periods of time when our sales growth has been subpar and where our total par value has been out of the sweet spot. I think we've done a pretty good job on total quality, on earnings stability, and on balance sheet, on everything. But maybe that's where our goal lies with the roundtable for the next year or two, on keeping an eye on that portfolio-centered management and forcing us to move in that direction.
Yeah, and in fact, I'm going to again invite the audience to attend and witness this, because we are in a situation right now which is kind of cool. We can take a look at the portfolio perhaps when we go offline here. It's becoming a challenge to keep the overall portfolio return greater than the market. And the reason for that is we're succeeding. All of our stocks are doing pretty well. The flight to quality is in full gear. Many of our stocks, your Universal Displays, your Microsofts, our success is really kicking us in the side. And it's a topic I think we're going to cover in great detail on May 26th when we get together next. I mean, we've been kicking it around for a couple months now. We sold quite a few stocks last month in a portfolio-centered manner, and we're still having trouble keeping the overall average above the market. I've not seen anything quite like it.
Yeah, it's I don't know if y'all covered it all earlier, but most better investing style, NAIC style managed portfolios, 10 Cup and Roundtable and Manifest 40 are three examples on Manifest. The portfolio's actually not running below the sweet spot, it's running below my par.
Yeah, that's what I've got on the screen right now, Si. The Roundtable tracking portfolio, the portfolio average is 12, and the market average is 12.4.
Well, and we should point out that this portfolio is not including any cash to drag those percentages down either.
No.
Right.
So these are just percentages based on the stocks that we're holding. I think when we look at it from a little bit closer up and we're not sitting in the roundtable situation, Si, we need to ally with each other and maybe push this portfolio center stuff a little bit more than we've been doing.
Yeah, and I've been hearing it for a long time, and I'll confess to being a little bit weak sometimes when it comes to this. What I think will be fascinating when we get together next Tuesday, we're going to be looking at selling. Now, we might give United Airlines a break because that's a Hugh McManus special situation. But if we sell a handful of these companies at the bottom with the lowest return expectations, by the way, our beloved Apple, everybody, moment of silence. We might actually sell Apple next Tuesday. Another thing that we'll look at in greater detail that I think is just fascinating, we will actually be at the point where we've taken out as much money as we put into the portfolio. We'll cover this in greater detail, but our net cash infusion will be zero, and we'll have a $400,000 balance.
Mark, I want to correct something you just said so that people don't write down something incorrect. The roundtable is the 26th of May, and that would be a week from this coming Tuesday, not next Tuesday, a week from.
Yeah, my heart about went out too, Ken. I was going to say, my gosh, I missed it by an hour today. You're going to miss me by a week.
Yeah. All right. Let's go ahead and.
So we're at 2 o'clock, Mark.
Yeah, we're at 2 o'clock. Let's go ahead and wrap up. Again, there's your invitation to the roundtable. And if I'd just gone one more slide, I would have seen May 26th, and you guys wouldn't have had to have cardiac moments. But yeah, I think that's going to be. We're going to be talking portfolio-centered decision making, and doing it. So everybody's invited to that. So with that, do you want to take some questions now, Ken, or?
Well, Mark, one of the biggest questions is where can I get copies of the slides? And folks, if you just read this slide, I know it has a lot on it, but right down there in big dark blue letters, it tells you the email address where to write to get copies of the slides. The second most asked question, Mark, is will this be available for reviewing? And the answer is yes. You want to go to the YouTube and to the YouTube. You want to go to the Manifest Investing Roundtable channel on YouTube, and you'll find it. A Google search under the name of this class will also take you right to the right place on YouTube. We would advise you sign up for the channel, and then you'll get a notification every time something new gets posted to the channel. And that's where we keep all of the roundtables, all of the Two Guys Plus Friends discussion, and all of the COVID cancellation conference that we're doing right now.
Si, you missed.
So with that, go on, Mark.
Si, you missed the part. That's the car that either Ken or my wife are buying me.
Ah, okay.
It's
I
Bentley.
Well,
am definitely
it's Si, it's not Ken. So okay.
And then the other thing I want to make sure we did this live is Si. We turned this from the Two Guys into the Three Amigos.
Yes.
So wanted to make sure you were aware of that. Wanted to make sure we did that live. I'm gonna go ahead and shut down the recording just to save the space on that. And again, thanks everybody for attending, and let us know if we can help you in any way. Thanks, Ken and Si.
Thank you, Mark.